We like to say that leases. You see that a lease is a contract. A lease is a contract. A lease is a contract. A lease is a contract that conveys the right. A lease is a contract which conveys the rights. Which conveys the right. Sorry, this should be IFRS 16, not IFRS 15. That should be IFRS 16, not 15. 15 is for revenue recognition. I will say that we are saying that a lease is a contract that conveys the right to use, which conveys the right to use an asset, the right to use an asset for a period of time, in exchange for a consideration, in exchange for a consideration, in exchange for a consideration. Full stop. It's a contract between two parties. It's a contract between two parties. It's a contract between two parties where one party known as the lessor, where one party known as the lessor, in bracket, that's the owner of the asset. Where one party known as the lessor, in bracket, owner, gives another party known as lessee, gives another party known as lessee, gives another party known as lessee the right to use the asset, the right to use the asset, the right to use the asset, and enjoy all benefits, and enjoy all benefits, and enjoy all benefits and risks associated, all the benefits and risks associated with the use of the asset. Associated with the use of the asset. Yeah, so you're saying that a lease is a contract between two parties. One party known as the lessor, that's the owner, and the other party is known as the lessee. Yeah, of which nowadays is it's actually the norm of how the business are conducted. Even the government nowadays, they are not buying assets such as vehicles and machines. They just lease for a given period of time. So how do you account for leases? Then you like to say that in order for such contract to exist, 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 comma, the user of the asset need to have the right to, the user of the asset, the user of the asset need to have the rights to, the user of the asset need to have the rights to, A, obtain substantially all the economic benefits. Obtain substantially all the economic, obtain substantially all the economic benefits from the use of the asset, from the use of the asset, from the use of the asset. Number two, the right to direct the use of the asset, the right to direct the use of the asset, the right to direct the use of the asset, the right to direct the use of the asset. So now let's look at type of leases. Types of leases. So first of all, let me explain, don't write. We have 4 types of leases. Number 1, we have an operating lease. Number 2, we have finance lease or capital lease. Then we have sale and leaseback lease. And then number 4, we have leverage lease. What's the difference between the 4? Now, an operating lease is a short-term lease. It's also known as a balance sheet lease. A finance lease or a capital lease, they are long-term lease. And I know that they are long-term. They are long-term in that the lease period is at least 75% of the asset economic life. Then we have the sale and lease back lease. Now, sale and lease back lease, this is why we had two parties. We had the owner, that's the lessor, and then we had the lessee. So the owner was the lessor. Now, the lessor had leased the asset to the lessee. And then over a given period of time, the lessor decided to sell that asset. Not now to lease, but to sell asset to the lessee. And then the lessor leases it back from the lessee. That means in this case, the lessee becomes the lessor and the lessor becomes the lessee. That's what we call the sale and lease back lease. And then number 4, you have what we call a leverage lease. Now, a leverage lease, leverage refers to the use of the debt. So a leverage lease is the lease whereby there are some financial obligation outstanding. For example, assume that in this contract, they were leasing a machine which had costed 5 million. But for the owner to buy this asset, I've gotten the finances from the bank. So that means the lessee will be paying the lease rental to the lessor, and then the lessor use that lease rental to finance or to pay the bank loan. So that's what we call a leverage lease. It's a lease with some financial obligation outstanding. Another characteristic of leverage lease is that it has three parties: the lessor, the lessee, and the financial. So we're looking at type of leases. Number 1, operating lease. Operating lease. Stroke of balance sheet lease. It's also known as of balance sheet lease. Of balance sheet lease. Let us see that. This is a short-term lease. This is a short-term lease with the following characteristic. This is a short-term lease with the following characteristic. The short-term lease with the following characteristic. Number one, the lease period is very short relative. The lease period is very short relative to the economic life of the asset, relative to the economic life of the asset, relative to the economic life of the asset. Number two, lessor, that's the owner, lessor incurs all the operating and maintenance costs. The lessor incurs all the operating and maintenance costs. Another characteristic, the contract can be cancelled anytime. The contract can be cancelled anytime before lease contract maturity period, before the lease contract maturity period. Number 4, the lessee is not given the option. The lessee is not given the option to buy the asset. The lessee is not given the option to buy the asset, at the end of lease period, at the end of lease period. Good. So that's operating risk. Now let's look at finance risk. Finance/capital risk. Finance/capital risk. This is a long-term lease. This is a long-term lease in which the lease period is relatively equal to the economic life, to the economic life of the asset, is relatively equal to the economic life of the asset. It has the following characteristics. has the following. Now, why are you lost? So where can you, where are you lost? So that I start from there. Characteristic of finance risk. Okay, let's write again. Looking at characteristic of finance risk. Number one was that. Number one was there is period. There is period. Is at least equal to 75%. There is period. Is at least equal to 75% of the asset economic life. Of the asset economic life. Of the asset economic life. Number two, there is C incurs or operating and maintenance cost. There is C incurs or maintenance, or operating and maintenance cost. Or operating and maintenance cost. Number three, lease contract cannot be cancelled. The lease contract cannot be cancelled. The lease contract cannot be cancelled before there is contract maturity period. Before there is lease contract maturity period. The contract cannot be cancelled before there is contract maturity period. And lastly, number four, there is C is not given an option. There is C is not given an option to buy the asset. Sorry? Ah, good. So you are listening, eh? Yeah. So there is C is given an option to buy the asset. There is C is given an option to buy the asset at the end of this period. 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 Yeah, there is given an option to buy the asset at the end of lease period. Good. Then you write another paragraph. You see that? The above characteristics for both operating and finance risks, the above characteristics both operating and finance risks are also the notable differences between the two lease contracts. Now let's look at number 3, sale and leaseback risk. Sale and leaseback risk. You see that? This is where the lessor sells the asset under risk, to the receipt, or another party, and then lease it back, Number 4, leverage risk. You see that? These are risk contract, whereby the underlying asset under risk, has some financial obligations outstanding, Full stop. Then it also write that. Leverage risk has 3 parties. Leverage risk has 3 parties. Semicolon. Lessor, lessee, and financial. Good. Those are the 4 types of leases. So now let's look at accounting for leases. Accounting for leases. Start by receipt. So we look at initial recognition. So how do we account for it by receipt? Initial recognition. Let me see that. At the commencement date, in bracket, the date the lessor makes the underlying asset, available for use. The date the lessor makes the underlying asset available for use by the receipt. Now close the bracket. close the bracket. The receipt recognizes, the receipt recognizes, the receipt recognizes, the receipt recognizes. Number one, or number A, lease liability, lease liability. And number B, right of use asset, stroke right to use the asset. One is the lease liability. Then number two is the right of use asset, stroke right to use the asset. Yeah. See, in this case, we say that for lease, for example, assume that the lease contract is for 3 years, and the lease period was the economic life of the asset is 3 years. So that means the receiver will be using this asset for the next 3 years. So the lessor have transferred the substantially all the right to enjoy the benefits as well as you take the risk. So the company using this asset, remember this asset does not belong to you, it belongs to another party, of which there is some consideration you expect to pay. That's what we call the lease rental. In case you expect an outflow, that's why you need to recognize liability, that this asset is not yours, you'll be paying some financial obligation. That's what we call the lease rental. But why are you using this asset? Because by the virtue of using this asset, you expect some financial benefits. That's what we call economic benefits. So therefore, you have to capitalize the asset because you're using this asset so that you can have some economic benefits. So therefore, you have to capitalize the right of use assets or the right to use the asset. Now, this one will go to the liability, and this one will go to asset. Good. Now, let's start with the first one, lease liability. How do you determine the lease liability? Lease liability. Lease liability. You see that? This is equivalent to the fair value. This is equivalent to the fair value of the asset. It's equivalent to the fair value of the asset. Full stop. Then what is that? The lease liability is initially measured. There is liability. There is liability. Is initially measured. Is initially measured at present value. Is initially measured at present value of lease payment, of lease payments, present value of the lease payment not paid at the commencement date. Lease payment not paid at the commencement date. Discounted at the interest rate. Discounted at the interest rate of the lease. Discounted at the interest rate of the lease. Discounted at the interest rate of the lease. Now, this is what I mean. To determine the lease liability, of which you're saying is equivalent to the fair value, you'll take the present value of all the lease payments not paid at the commencement is the present value of lease payments not paid at the commencement. What does it mean? Now, assuming that you enter into a contract for 3 years, and then you agree that you'll be paying 1 million each year for the next 3 years, then due to time value of money, assume they are charging an interest of 10%. How do you determine the lease liability to recognize initially? To determine the lease liability, you take the present value of the lease payment. You say you'll be paying an amount of 1 million each year. So therefore, it's an annuity for the next 3 years. So how do you get the present value? So it's present value interest factor of an annuity. The interest rate is 10% for the next 3 years. Now, that's how you determine the lease liability. Number B, right to use the asset. 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 Right to use the asset is initially measured. Is initially measured is initially measured at its semicolon A, at its semicolon A, lease liability, A, lease liability, B, an initial direct cost, and then number C, the payment made in advance, payment made at or before lease commencement date. Lease commencement date. Lease commencement date. Yeah, that's how to get the right to use the asset. The right to use the asset, we are saying that it will comprise, number one, you take the risk liability, you add any initial direct cost incurred, maybe some legal cost, you capitalize that cost, and then you add any payment that you had made in advance. So most of these one would be applicable when the lease rentals are paid in advance. Now that's how you get the right to use the asset. Now this is what now you show to the balance sheet as part of non-current asset. So can you show this? Show that right to use the asset, you take the risk or liability, you add any initial direct cost, then payment made at the commencement. Now, you see, you have said that this right to use the asset will be capitalized as part of non-current asset. But the risk period is 3 years. And you see, being a machine, if you are leasing a machine, you expect the machine to reduce in value. That means you have to provide for depreciation. How do you depreciate? Now, this was initial recognition. Now, subsequently, you need to depreciate the asset. Now, that's why you apply IAS 16, the cost model. Now, how do you depreciate? Now, when depreciating the risk item, you depreciate based on the ROA of the risk period and the economic life of the asset. Now, for example, in this case, you had leased for 3 years, but the economic life of the machine was how many? 4 years. So when now depreciating, and we don't depreciate the risk liability, we depreciate the right to use the asset. Now, this is the asset. This one is liability. For the liability, we amortize by preparing the amortization schedule. For the asset, you depreciate, and you're saying that you depreciate based on the ROA of the two. Then we like to say that the right to use asset, the right to use the asset, will be measured subsequently. The right to use the asset will be measured subsequently, at cost less accumulated depreciation, at cost less accumulated depreciation, and impairment losses. Measured subsequently at cost, less accumulated depreciation, and impairment losses in accordance with the cost model, of IAS 16, in accordance with cost model of IAS 16 PPE, IAS 16 PPE. The right to use the asset is depreciated. The right to use the asset, it will be depreciated based on the area of, based on the area of, based on the area of lease period, lease period, lease period, and economic life of the asset, and the economic life of the asset, and the economic life, and the economic life of the asset, and the economic life of the asset, economic life of the asset. So I want us to do an illustration. So take out your handout. Handout page 4. Handout page 4. Handout page 4. We'll do that question number 1 on leases. You are told that Royal Contractors Limited owns an item of plant used for construction with a carrying value of 14 million as at 31st December 2015. Carrying value, that's the carrying amount. What is carrying amount? That's the same as net book value. The firm won a construction contract and decided to sell and lease back the machine on that date under the following condition. Selling price 40 million. This was also the fair value of the plant. So they decided to sell. And how much was the selling price? 40. But how much was the net book value? So how much was the gain on disposal? So gain on disposal, you take 40 million. The carrying value was 14 million. That means there was 26. So the first bit you have that the selling price was 40. This was also the fair value of the plant. Say that the fair value is the same as lease liability. That's what now you need to amortize. Lease rental payable annually in arrears amounted to 15,521,200. Now, when making the payment for lease, you can make in 2 ways. There is those lease rentals payable in advance, such as rental income. Such as rent. And you have those payable in advance, in arrears. So this one we are paying in arrears. Lease duration for the machine was 3 years. Economic life for the machine was also 3 years. So these are finance risks. Now, under old IAS for leases, we are only accounting for finance risks. For operating risk, the receipt does not account for it. But now under the new IFRS 16, finance risk and operating risk are accounted the same. So there is no difference now between the two. Now in this case, the lease period was 3. The economic life was also 3 years. So in short, we have leased 100% of the economic life of the asset. So these are finance risks. The implicit interest rate is 8% annually. Required financial statement extract for the 3 years. So how do we account for this? Now, under initial recognition, you need to determine the risk liability. And how do you determine the risk liability? So that risk liability is the same as fair value, of which in this case you are given. If you're not given, how do you compute? So go back to the definition of risk liability. Say that what's risk liability? Is the present value of lease payment not paid at the commencement. So you agreed you'll be paying how much? How much was the annual lease rental? So it's the present value. So you agreed that you'll be paying an amount of 15,521,200 for a period of how many years? 3. So get its present value, discount. Present value interest factor of an annuity. Interest rate is 8% for the next 3 years. So it will be 15,521,200. 1 minus 1 plus R, 0.08 raised to power -3 divided by 0.08. So it will be 15,521, 200. You mean to 4 decimal places? That's 2.70. So how much will be the present value? You get approximately 40 million. Good. It's the same as the fair, but remember that the fair, number one, the selling price was 40 million, and this was also the fair value. So in case you are not given the fair value, that's how you determine, by discounting the expected cash flows. Now, this is now what you amortize for the 3 years, because these are liability. What about, you also need to capitalize this asset. To capitalize, you need to determine the right to use the asset. And how do we get the right to choose the asset? So that to get the right to choose the asset, you take the risk liability, of which we have it's an amount of 40 million. Then you add any initial direct cost, which was 0. Then you also add payment made at the commencement. But in this case, we are paying in arrears. So that means nothing we paid at the commencement. So that means also the right to use the asset will be the same as risk liability, an amount of 40. Then this right to use the asset is what you capitalize, and then you depreciate. So how much will be depreciation per annum? Now you will take the right to use the asset, which is 40, based on the row of the economic life was 3 years, lease period was 3 years. The row of 2 is how much? 3. You get an amount of 13, 3 recurring. Good. So how do we account for it? So we need to amortize the liability by preparing the risk amortization schedule. So here we have the years. So they sold that asset. So it's 2015. So it will be 2016, 2017, 2018. You have the balance brought down. Then you determine the interest at 8%. Then the payments. Then for the payment, in case you are paying a loan, that payment comprises of 2 elements. One is the principal and the interest. So how much is the principal? Now the principal is the one that reduces your debt. And then we'll have the balance carried down. The balance brought down, you take the risk liability. We are amortizing the liability, which is an amount of 40. Then the payment does not change. The payment is an annuity. We agree we'll be paying an amount of how much? 15,521, 200, 15,521, 200, 15,521, 200. So now let's get the interest. 8% of what you get an amount of 3.2. Now we want to get the principal. I repeat again, that the payment is made up of the interest and the principal. We paid them 15,521, 200, of which the interest was how much? 3.2. So you minus the interest to determine how much was the principal. You can call it A, you can call it B, you can call it C, you can call it D, you can call it E. So to get D, you take the payment C minus the interest B. So how much was the principal? Then let's get the balance carried down. To get the balance carried down, you take the balance brought down, you deduct the principal. So to get E, you take A minus D. What do you get? Sorry? 678? 800. Then the balance carried down becomes the opening balance. So you have 27,678, 800. 8% of that is how much? Sorry? 14. Yes. 104, 14. 14. 304. Then you paid 15,521, 200. So take this first of all, you eliminate the interest to determine the principal. 13. 306. 896. To get the balance carried down, you take the balance brought down, you eliminate the principal. So how much will be the balance carried down? 14. 371. 904. The balance carried down becomes the opening balance. So we have 14. 371. 904. 8% of that is how much? 11. 49. 7. So you take the payment, you minus the interest to get the principal. 14,371, 448. So to get the balance cut down, check the balance brought down, you minus the payment. You equate it to 0. You see, there was a small balance of 400. Imagine out of 40 million, you start arguing because of a balance of 400. So you equate it to 0. So how do we account for it? By the result. I mean by the receipt. What do we take to the income statement? What do you take to the balance sheet? So we prepare the income statement extract. Here we have 2016, 2017, and 2018. So under the incomes, there was a disposal gain. Disposal gain you recognize immediately in the financial statement, amount of 26 dash dash. Then you factor in expenses. As the receipt, you are paying interest. So we have interest expense. As the receipt, you are the one depreciating the right to use the asset. So you factor in depreciation. So the interest expense, we have it here. So the first year, 3.2, year 2 we have is 2214, 304, and then 2018 we have an amount of 1149,752. Then here we had depreciation per annum. They depreciate the right to use the asset. What about the balance sheet? So we prepare the statement of financial position extract. (2016, 2017, 2018). So first of all, you start with the assets. With the assets, we have an uncurrent asset. You characterize the asset, right to use asset. How much was the right to use the asset? It was 40. That was initial recognition at the beginning. But at the end, remember we charge depreciation. So you take 40 million. 2016, how much was the depreciation? Yeah, you minus 13, 333 to get an amount of 26,666, 667. Then you take this, you minus depreciation for the second year. What do you get? Get 13,333, 333. 2018, you get 0. Yeah, the asset will depreciate fully. Then you have capitalized the asset, but this asset does not belong to you. It belongs to the owner, of which you expect to see some to pay some amount. That one becomes obligation. So we have non-current liability and we have a current liability. So we have lease obligation. Also, yeah, we have lease obligation. Now, when you're paying in arrears, non-current liability will take the balance carried down. To the current liability, you take the principal. Now, what's a liability? Okay, what's the difference between a non-current liability and a current liability? What's the difference between the two? One is long term, the other one is short term. What's the current liability? And short term is relative, right? Together? Yes. Current liability, let me start for you. Is the amount payable? Current financial year. And what about the rest? The amount payable? Hey. Yeah, what's the current liability? Is the amount payable? within one accounting period. That's very wrong. Within a year, also that one is very wrong. Any amount payable within the year, it's no longer a liability. Are you together? Eh. Na mnalenga mko advanced, eh? A current liability is the amount payable within the next one financial year. Any amount payable within 1 year, it's no longer a liability. Are you together? Because we prepare the financial statement at the end of the year. What we have not paid by the end of the year is what's a liability. So that means what we paid during the year is not a liability. Amount payable within the next one financial year. So don't put that word next. Your definition is wrong. What about non-current liability? Amount not settled within the next one financial year? Yeah, good. So that means 2016, the liability is for 2017. What you're not able to pay in 2017. And that's why we see that for the non-current liability, you take the balance carried down. So for 2016, you take for 2017. For 2017, you take for 2018. So you take the balance carried down. So here you have an amount of 14,371,904 dash dash. To the current liability, you take principal. You take the principal. Yeah, the principal. So being a liability for 2016, you take for 2017. So for 2016, you take for 2017. And the principal will be an amount of 13,306,896. And this one will be 14,371,448 dash. I repeat again. What's the current liability? Amount payable within the next one financial year. Now, at the end of the first financial year, this is our year now, the outstanding balance was how much? 27,678,800. So within at the end of the next financial year, how much is the balance? 14. What is this 14? That means this 14 is not what we are not able to pay within the next one financial year. Therefore, becomes an non-current or a current? A non-current. I repeat again. At the end of this financial year, the balance was 27. At the end of the next financial year, the balance reduced to 14. There is a reduction by how much? Can you give me the difference between the two? Take the difference. Give me the difference between the two. Yeah, now that reduction of 13, which is the principal? Can you see the principal? Now, that reduction within 1 year, that's the amount they were able to pay within the next one financial? Within the next one financial year. Therefore, becomes a current what? Yeah, it is. Good. Now you can copy. Let's be quick. I want us to do as many illustrations as possible. Even if we extend our class. So kindly let's save on time. Take a screenshot of that. You'll copy later. Try another illustration. December 2022. Question 1B. I had already shared the question paper on the group. So part A of the question. Now, in the context of IAS 16 PPE, I told you that accounting for assets and liability, what you have in financial reporting will also be tested in advanced level. So accounting for assets, this one is not in our syllabus for advanced, but they have the right, anything you did in financial accounting, intermediate foundation level, what you did in financial reporting, that's intermediate level, it will be tested here. That's accounting for assets and liability. And in your handout, you have all those theories. So kindly, apart from the question you usually do from the handout, from page 1 to page 9 is only revision question. The rest are all AFR theories. So on that one, I don't discuss them in class because those are theories. That one you do them. So everything is there. So in the context of IAS 16 PPE, actually that one is in your handout. Explain how initial cost of PPE should be measured and treated of subsequent expenditure. Very simple. If you buy an asset, how do you recognize? Initially, at cost, actually, it's how you treat the right to use the asset. At the cost to acquire the asset plus any initial direct cost initially. Then subsequently, at cost less any accumulated depreciation. As simple as that, you get your 4 marks. Number 2, describe the requirement regarding to the revaluation of non-current assets, the treatment of surpluses or deficit on revaluation and gain or loss on disposal. Very simple. Gain or loss on disposal is recognized immediately as an income. Are you together? That's gain or loss on disposal. Just like, don't explain anything else. Those are 2 marks. Then, in case of a revaluation gain of an non-current asset, they should be recognized to other comprehensive income. Revaluation of PPE and available for sale, they should be recognized to other comprehensive income, not to other income. Gain on disposal is the one you take to other income, just below the gross profit. Now let's be here. Let me explain this. Gain or loss on disposal, you take it to other income. In case of revaluation gain or losses for PPE, once you prepare the income statement, income minus expenses, you get the profit after tax. After the profit after tax, that's where you capture other comprehensive income, and anything that goes to other comprehensive income, you also take it to the balance sheet as part of the equity reserves. Right together, that's the revaluation reserve. As simple as that. Gain or loss on disposal to other income, in case it's a gain. In case it's a loss, to expenses. Then revaluation gain to other comprehensive income, as well as a revaluation reserve. Those are 10 marks. Let's go now to part B of the question. It was on leases. Vox Limited leased a factory to Tiana. Who is the lessor? Who is leasing? Vox is who? Vox is who? That's the lessor. That's the owner of the asset, right? And then Tina becomes who? The receipt. Now, what we have done here, this was accounting by the receipt. What about if you are the lessor, you are the owner? How do you account for this? It's the opposite. Are you together? So instead of interest expense, You see, for us, we are showing an interest expense as the receipt. The result, it will be an interest income. Then this depreciation will not appear in your books because you are not the one using the asset. The asset you transferred all the right to the other party. So the other party is the one who provide depreciation. So to your income statement, under other income, you show the interest income. Then to the balance sheet, you will not show this. Come here to the liabilities. This party is showing a liability. What goes to the non-current liability, for you to show it as part of investment property. Non-current assets, for you to show as non-current asset. Current liability, show it as current asset. So that means you amortize the same way. To the non-current liability, you take the balance carried down. To the current asset, you take the principal. But this one now will go to the asset. As simple as that. Now, Vox Limited list a factory, Kutiana Limited, with effect from 1st of July 2022. The lease is for 4 years at an annual lease rentals of 4 million, payable annually in arrears. So in this case, we are paying in arrears. The lease contract provides that the lessee shall be responsible for the insurance and maintenance. And that's one of the characteristics of a finance lease. Will be responsible for insurance and maintenance of the factory during the lease term. The implicit rate on interest on lease is 15% per annum. Required. Demonstrate with suitable calculation the accounting treatment of the above lease transaction in the financial statement of Voxy. Voxy is the owner, that's the lessor. For the year ended 30th of June 2023, 24, 25, and 20. So initial recognition, okay, I want us we discuss the two, lessor and the lessee. So initially, you need to determine the lease obligation. But now you are the lessor, so you don't have anything to do with the obligation. So to you, it's your net investment. Net investment. And you say that, how do you get the lease obligation? Is the present value of the lease payment not paid at the commencement. So for you to be the present value of the lease payment not received at the commencement. Yes. So how much do you expect to receive every year? 4 million. How much the interest rate? 15. So it's present value interest factor of an annuity, 15%. There is period of how many years? 4 years. So therefore it will be 4 million times 1 minus 1 plus R, 0.15 raised to power negative 4, divided by 0.15. So it will be 4 million, get 2.50. So how much will be the net investment or the lease obligation in case of Paris? Sorry? 11 for 20,000, eh? Yeah. Then we also need to determine the right to use the asset. Do we need to determine that? No. But in case there, okay, let me show you. In case was the lessor accounting for it, I mean the lessee accounting for it, he could have determined the right to use asset as follows. You take there is liability, which is an amount of 11 for 20. Then you add any initial direct cost. In this case, there was no that. No, there was not any amount incurred. Also payment made in advance. In this case, there wasn't. So now this now what you could have now capitalized as an asset, and then you depreciate for how many years? For 4 years. But in this case, this is the owner. So the owner is not responsible for depreciating. Right together. This is the lessor. So this part, we'll ignore it. Now let's amortize the liability. Amortization schedule. How do we amortize? The amortization schedule is the same. So we have the period. Now the year ending 2023, 2024, 2025, 2026. The format is the same. Balance brought down. Then we determine what? Interest, but now it be interest what? interest income. Are you together? At the rate of 15. The other one for the receipt was an interest expense. Then there was payment. For you are not paying, you are receiving. So it will be what? Receipts. Then you determine the principal, and then you determine the balance carried down. And so the balance brought down, we are amortizing the investment of the liability, an amount of 11,420. Then the receipts is constant, it's an annuity. You'll be receiving how much? 4 million each year. And 15% of this is how much? 17? 13,000. So now let's get the principal. You see that the receipt had the interest income element and the principal. So you take 4 million, you minus 17, 13,000. So how much was the principal? Sorry? 22,000. So to get the balance carried down, you take the balance brought down. This was the principal paid. So how much will be the value of the investment at the end? 91? 33,000. The balance carried down becomes the opening balance. So we'll have 91, 33,000. 15% of that is how much? 950. 4 million minus the answer. You get the principal. 26? 050. So to get the balance carried down, you take the balance brought down, you eliminate the principal. 950. The balance carried down becomes the opening balance. We have 65,02,950. 15% of that is how much? Sorry? 443. 4 million minus the answer, you get 30. 324. 557. Then to get the balance carried down, to take the balance brought down, we minus the principal. Sorry? This one is? Yeah, that 24. So how much would be that? Yes? 392. The balance carried down becomes the opening balance. We have that 478,392. 15% of that? 521? 759. 4 million minus the answer. 3478. 251. 241. So the balance brought down minus this. Yeah, you get it to 0. Now, in case what by receipt, how could you have prepared the financial extract? So you prepare the income statement extract, you go to the expenses. You show 2 items: interest expense and the depreciation, in case it was received. Then to the balance sheet, the non-current asset, right to use the asset, you could have taken now the right to use the asset, you raise depreciation. Then to the non-current liability, you take the balance carried down, the current liability, you take the principal. But in this case now, this is the owner. So as the owner, you bought an asset, you are not using it, you have leased to another party. That's what you call an investment property. So how do we account for it? So income statement extract. So you have 2023, 2024, 2025, 2026. So you have the income. To the income, you have interest income. So this will be the interest income. 1713. 1,000. Here we have 1369, 950. 2015, you earned an interest of 975, 443. Here you earned 521, 759. Note that these are finances. So you as the owner, you don't depreciate. You are not incurring actually any cost. All the operating costs are being incurred by the receipt. So therefore, you don't depreciate the asset. Then what about the statement of financial position? Statement of financial position 2023, 2024, 2025, 2026. So here you only recognize an asset. You are the owner, so there is no liability. So to the asset, you start with non-current asset, and then you have a current asset. Now, current asset is what you expect to receive in the next one financial year. So here you have investment property or lease investment. Let's just show it as lease investment. Also here you have a lease investment. Here you see that you take the balance carried down. Here you take the principal. For 2023, a current asset is what you expect to receive within the next one financial year. So that means for 2023, you take for 2024. So for 2023, you take for 2024, balance carried down. Here you'll take an amount of 65,029.50. Here you'll have an amount of 34,78,392 dash dash. For the current asset, you take the principal. For 2023, you take from 2024. And these are the principal. You have an amount of 26,30,050. You'll have 30,24,557. I'll have 347,8241. So I want you to take a screenshot, you copy it because time is up and I want to do another illustration. Take a screenshot, you copy it. Now I want us to do an illustration where the lease payment are paid in advance. So take out your handout. There is a question in your handout. Handout page 28. Handout page 28. Handout page 28. So then you leave a space. I want you to copy that question. It's like a small, not now, you'll copy later. You copy that question before the solution. There's that illustration there. You're told that a company enters into a 4-year lease commencing on 1st of January 2011 and intends to use the asset for 4 years. The terms are for payment of 50,000 commencing on 1st of January 2011. Commencing 1st of January 2011. So that means we are paying in advance. Commencing 1st of January 2011 and annually thereafter. The interest rate implicit in the lease is 7.5%, and the present value of the lease payment not paid as at 1st of January 2011, that is the 3 payments of 50,000, discounted at that rate is 130,026. Legal cost to set up the lease incurred by the company were 42 shillings. Required. Show the lease liability from 1st of January 2011 to that 1st December 2014 and explain the treatment of the right to use the asset. The company enters to a 4 is commencing. So this is the receipt. How do you account for it? It's the same process. You determine the lease liability. So what is lease liability? Can you go back to the definition? Lease liability or lease obligation. How do you get it? It's the present value of at the commencement. Now, the lease contract is for 4 years. How much do you agree we'll be paying every year? We're paying an amount of 50. So to get the lease liability is the present value. So you'll take 50,000 times present value interest factor of an annuity. How much is the interest rate? 7.5. For how many years? For 3 years. Good. So it will be 50,000, 1 minus 1 plus R, 0.075 raised to power negative 3, you divide by 0.075. So this one will be 50. So give me that. Sorry, you get 2.600 005. So how much is that? 130 026, of which we have already been given in the question. Can we read the question again? Do you have any question up to that point? What's the question? Good, you don't have a question. A company entered into a 4-year lease commencing on 1st of January 2011 and intended to use the asset for 4 years. The terms of the 4 payments, the terms are 4 payments of 50,000 commencing on 1st of January 2011 and annually thereafter. The interest rate implicit on the lease is 7.5 and the present value of the lease payment not paid at 1st of January 2011, that is the 3 payment of 50, discounted at that rate is that 130,020. Do you have any question before I proceed? What's the question? Why are we using 3 years? The lease contract was how many years? 4. Can you go back to the definition of lease liability? Let's go back to the definition of lease liability. Okay, can you read for me that? What do you mean by lease liability? Is the present value of the lease payment not paid at the commencement? Now listen here. This contract is 4 years. Are you together? At the beginning, we need to pay how much? Do you pay after getting the asset or before getting the asset? Before getting the asset. That's why you say that to get the lease liability, this is for 4 years. But at the commencement, we are paying in advance. The first year, you had first of all to pay the amount of 50. So the lease liability is the present value of this payment not paid at the commencement. So it was 50, 50, 50, 50. At the commencement, you paid them 50. So how much is remaining now? for the next 3 years. Even if you discount this, 50,000 at year 0, so it will be 1. Are you together? Now let's get the right to use the asset. Right to use asset. How do we get the right to use the asset? You take there is a liability, you add any initial direct cost, and then you add any payment made in advance. How much was the lease obligation? It's 130,026. Then you add any initial direct cost. Legal cost to set up the lease incurred by the company was an amount of 402. And then the payment made at the commencement. You had paid an amount of how much? Yes, you had 50 because this 50 is not there in your lease liability. You see, this liability is what you expect to pay. At the beginning, you already paid 50. So therefore, that one is no longer liability. So the liability is the remaining for the 3 years. So how much will be the asset? 180? 456. 662, right? 428. This is 50. 130 plus 50, you get 180, right? Here we have 42 and we have 260. How much is that? Oh, it was 026. Correct. This was 130,026. How do we call that error in accounting? Instead of 26, you write 62. So this one you get 420. 428. Good. Now this right to use the asset is what now the company will depreciate. Depreciation per annum. You take 180, 428. You divide by what? Oh yes, good. 90 divided by 2, get how much? 45,000? 107. 107. Now let's amortize. Amortization schedule. So we reason here because how we prepare the amortization schedule when the lease is payable in arrears and in advance, they are totally different. So we have the period. It was for 4 years. 1, 2, 3, 4. We'll have the balance brought down. Then you are paying at the commencement. So you pay before you determine the interest. You start with the payment so that you determine the balance due at the beginning. Now you pay the interest based on the balance due. And then we get the balance carried down. How much the balance brought down? All the figures are here. How much the opening balance? 1? Is that 130 or 180? That's why I had to ask you the question. Now, 180 is what you capitalize. Are you together? We don't amortize the asset. We amortize the liability. So therefore, how much will be our balance brought down? Good. 130,020. Then you paid them at the commencement. How much is the payment? 0. How much? 130,020. Let me repeat again. This 130, it was the present value for the remaining 3 years. Are you together? Because when you're entering into this contract, you had already paid 50. It's no longer a liability to you. Are you together? So it's 130,026. You had already paid at the commencement. So you're not paying again. So it's 0. So this is the balance due. Then you accrue the interest 7.5%. 7.5 of this is how much? Sorry? 52, eh? So now let's get the balance carried down. This will get the balance carried down. Now at the beginning, after paying the 50, this was the obligation, right? But during the year, you are charged an interest of how much? 97.50. So how much is your net obligation at the end? You take 130,026, you add the interest accrued for the year to get the net liability. How much is that? Sorry? 139,770. So the balance carried down becomes the opening balance. 139,778. You pay. How much is the payment? 50. Good. 50. You paid 50. How much will be a balance due? 80. Sorry? 80. 770. Now you pay the interest based on this outstanding amount. 7.5% of this is how much? 67? 33. So the outstanding amount was this. Then during the year, this was interest accrued. So how much would be the balance carried down? You add 511. The balance carried down becomes the opening balance, 96,511. Then you pay an amount of, at the commencement, how much will be balance? 511. Now you pay the interest based on the outstanding amount at the beginning. 3480. This was outstanding amount at the beginning of the year. Then it was interest charge for the year. So how much will be the balance carried down? 50. You get 50. Then the balance carried down becomes the opening balance. So the opening balance will 50. Then you pay how much? 50 at the commencement. So how much will be a balance due? Interest for the year? So how do we prepare the financial statement extract? So income statement. So year 1, year 2, year 3, year 4. So here we have the expenses. We have two expenses. One is the interest expense, as well as you depreciate the asset. So here is the interest expense. We have 97, 52, 67, 33, 34, 88, 0. This was depreciation per annum, amount of 45,107, 45,107, 45,107, 45,107. What about the statement of financial position? And this one is an extract, so don't expect it to balance. Year 1, year 2, year 3, year 4. So number one, you have the right to use the asset for the next 4 years. So you characterize that asset, non-current asset, right to use assets. Now, right to use the asset is an amount of 180,428. Then you apply IAS 16. You need to depreciate. Year 1, you charge depreciation amount of 45,107. How much will be the net book value for the carrying amount? 420, 421. And then you raise 45,107 for year 2. 90 to 11. You raise 45, you get. Then non-current liability and the current liability. So here we have a lease obligation. Also here we have a lease obligation. Now for those who crammed, what do you take to the non-current liability? Balance carried down. What do you take to the current liability? The principal. Now that's when there is a payable in a when they are payable in advance, the non-current liability will take the balance due and the current liability will be a payment. Now, current liability will take the balance due. This is what I mean. So you see, you have the balance due. Now, at the you see, year 1, to get the liabilities from the next financial year. So the next financial year, this was an opening balance, but we paid them 50 for that financial year. So what we're able to pay within the next one financial year becomes our current liability, and that's why we're saying that to the current liability you take the payment. So for year 1, you take for year 2. For year 2, year 3. Year 3, you take for year 4. So take these payments. So here will be 50, 50, 50. Year 4, you did recognize. Then, to the non-current liability, you take the balance due. This was the opening balance. You paid them 50. So how much is the balance at the end of year 2? Yeah, that means this 89 is what we are not able to pay within 1 year. So that's what you will take to the non-current liability. 89,778. That would be 46,511 dash. So now you can copy. And for your own revision, you can take the same question. You double the figures. I'm showing you how to set an exam for yourself. You change the figures. You either multiply by 2. Then you try to do what we have done if you want to understand this. But if you just cram this, you won't understand anything. Go and try to change the figures. Then try to do it by yourself. Until you amortize, you get a 0. And then what do you take to the non-current liability? What do you take to the current liability?